And as always, we're going to be looking for accurate context, good risk management, and always exercising good patience.
Everybody who's traded has gone through periods of time where their strategy hasn't worked.
Where if not a hard stop, you should reevaluate the trades you're in based on time.
That's what we're here for, is to put ourselves in the best success. A trading routine does that, builds that habit, lets you know what to work on, what to reflect on, and what to improve on the next day.
Hello, friends and traders. Welcome to the Coach's Playbook. I was about to say limit up, Dan, but I caught myself at the same time there. It's Tuesday. It's pre-noon. It's June 14th. It's 100 degrees in Chicago. So we should have the summer doldrums right now, right? Not the case. Everything got hammered yesterday, and we thought that would be a good thing to talk about. So the title today is, what is the most important thing traders do? And I would argue the most important thing traders do is preserve capital, because the second you don't preserve capital, you have no capital and cease to become a trader. So after everything we've seen happen with Bitcoin, with the NASDAQ, things like that, I think we wanted to talk a little bit today about our views on what responsible capital preservation is, and just the few hard mathematical facts. So today, Mick, you have a shout out. And then, you know what? You can get us started today.
I got excited there. I thought you were just directing it to me. Yes. Well, thanks. Appreciate it, Jack. I do have a shout out. Big shout out to Luis Lopez, up over $5,300 today, trading the NASDAQ. That's a big winning day. So love seeing it. Way to take advantage of this price action in the market today. And then, I will take it away. Thank you so much. As far as, most important thing, capital preservation, Jack said it. It is the single most important thing. I mean, it's your greatest tool to make money, is the money that you have in your account. You need to post margin. You need to be able to, have ammo, as we say, for trading. I also think it's probably, for new traders out there, it's the most boring thing you could possibly hear too. I remember when I started trading, I'm going to come in, I'm going to make a ton of money. I wasn't so much thinking about, I wanted to protect what I started with and what I had, or even what I made too, as you start making money. But preserving the capital is first and foremost. I know new traders, the goal here is to make money. So a lot of people focus on the making money side of things. Only to find that if you're focusing on that and only that, you are going to have losses. Your losses are going to be bigger than they should be. And then you might wake up one day and, find out that you're not able to trade. And that's not at all what you want. So, you got to protect the profits. You got to protect your own account in general. People think about making the money. That's the offensive side of the business. Most of this business is actually defensive, and protecting what you have, managing what you've made. I think that's it right there. I know there's more to say. I'll kick it over to the next person, whoever's is unlucky to be second or third this time around. I'm really rubbing it in your faces, guys, because I'm always at the end.
Yeah, great lead off there, Mick. Well, we'll start with some of the immutable math of futures trading, which is if you start with a certain amount of money in your account, if you lose 5%, you need to make back 5.3% to break even. At 10%, 11.1%. Then things start to accelerate by geometric multiplication, right? If you lose 30%, you need to make 43% to break even. 50% you lose, you need to make 100%. 90%, you need to make 900%, and 95%, 1900%. Now, many of you will be familiar with that, but I think it's important to point out too that these go both ways. So you can do the exact reverse and say that if you make 100% and double your money, well, if you lose half that, you're back to where you started. All right. Even if you make, say, 300%, well, 75% drawdown will bring you back there. So the drawdowns are always going to hurt more from a percentage basis than the positive side of that. than your big build of the account. And I think that we see, I'll kick it over to Hogue next, but I think we see constantly, and Mick, you're a risk manager, is people that make a bunch of money will size up too quickly because they have a lot of equity in their account. And then if they have, say, made 1,000% on their capital, it's much easier to wipe that out by losing the 75% when you size up at the top. And I think we've seen that happen many a time along the way. Hogue, I'm sure you have, so I'll let you throw out there next about this or anything else you want to talk about as far as preserving capital.
Sure. Thank you, Jack. And hello, gentlemen. It's quite simple, but difficult to do as a human being. When you think about it, the less you lose, the more you're going to stand to make, right? So the problem is, and Mick, you see this, we all see this at Top Step. We've seen it in our own trading. Sometimes when we have a really good day, a really big day, we know that I'm at risk for a big loss the following day. For some reason, just having that extra money in there makes traders in general think that they've got all this that they can now risk, and they can leverage more or risk more on their stops. It's just not really the case. I know we still do call people after they've had a really big day and just warn them that they're probably going to be at risk for one of their worst days the following day.
It's the last thing someone wants to hear, but it holds so true.
But the thing they need to hear the most, and so much paradox in trading, that's one of them. You just had a really good day. You don't want somebody to call you and say, hey, watch it tomorrow because you're at risk of having a really bad day. And it comes down to basic human nature. Nobody likes to take a loss. And, especially for newer traders, retail traders, the first time you put on that trade and it's against you, you kind of default to, well, I'll just wait. The market will come back and make me whole again, or even make me money. And you're going to find 99 times out of 100, that's not going to be the case. You got to take your first stop. Your first stop's always going to be the best out in a losing day, in a losing trade. And then the other side of that, on the offensive side, especially if you've had a couple of losses, that first winner that you've got on, it's going to be real tempting to try and just take that winner off at a $50 loss, even though you just lost 500. And that's just human nature. So when it comes to risk management, you always want to be looking for asymmetric opportunities where you can risk a little to make a lot more. And if you were watching the market forecast yesterday, my number one goal this week, knowing that we've got the FOMC meeting, we're going to see volatility, is not to make money, it's not to lose money this week. And that's my risk management for this week is, I'm not here to try and make a whole bunch of money. I'm just here to make sure I'm here next week and able to operate in the market.
Yeah, I think you have to tread very careful today, especially going into this is one of the most uncertain Fed meetings in a long, long time. I wasn't really expecting the CPI to run as hot as it did. And now it's kind of really up in the air how much this rate cut is going to be. So stay there, be careful. Let's go back to like a practical example of what I think people do with the reason why after a big day you might lose is your limits, your puke limits, be it for a day, for instance, should always be a percentage, some percentage of what you have, and not how much you could absolutely lose. I think we see sometimes, so say someone has $1,000 loss limit, has a great day, they make $3,000. All right. Instead of using some percentage of what they had and say like, okay, well now I have more capital, I'll do a 1250 puke limit today, protect some of the capital I have. It'll be like, well, I had $1,000, I made 3 more, I could lose $4,000 today. And that's not a sustainable way to do anything. You're going to keep on ending up where you started if you do that. Whereas with a percentage and sticking to it, if you're doing a strategy that's working, it's going to build and you're not going to lose everything on one day.
Yeah.
Dan?
Jack.
Oh, sorry, Mick. Go ahead.
You can kick it over. I was just going to really quickly, I was going to say, this is a business where a lot of people tread water. They make money, they lose money, they make money, they lose money. They never really grow their account. And, that's a large group of people. If you are treading water for a period of time in this business, you're doing all right. But the difference between separating yourself from someone who's treading water and someone who's growing an account and paying themselves over time, you have to think about these kind of things. It is a business, and, you have to assess your risk and plan, plan for losses and what you're going to do if you get there. Anytime you have a plan predetermined ahead of time, you have much more control of doing what you say you should do, or just doing what you should do, as opposed to not having a plan. If you don't think about these kind of things and you just go in there and trade, you're going to freeze up. You're going to be a deer in the headlights. And, these losses are always going to be larger than they should be if you're not planning for that.
That's a good point. Now, Dan, your time to shine. You went first.
It's my
last
turn,
week, so.
finally.
Yeah.
I'm ready. No, Mick, you bring up a good point there. I do want to touch on that, right? If you failed, what's the standard cliche? If you fail to plan, you plan to fail. But really it comes down to, if you don't have a solid plan, as soon as you walk into your trading day, as soon as you start entering into the market, you become emotionally biased. Your emotions take over and you're not thinking properly. I think a prime example of this is, people will say, hey, I want to set a personal loss limit. Let's call it $500. They hit that $500 in the first half hour of trading. How often does that person, as their first instinct was, gosh, if I just had a little bit more, I could keep going. I could get this back. And that's like this mentality you have to try and avoid. But really, when it comes down to this whole
some feedback
concept,
we've had, I would say that is often the case, Dan. Sorry.
Absolutely. No, you're right. You're spot on. And that's really what it comes to. I mean, I've been there where I'm like, gosh, I think I could do this if I just had a little bit more room. It's the same thing, if you're at the casino, you're playing blackjack and you put $500 down and you lose it all in the first 5 hands. It's really easy to go, man, that ATM is calling my name. If I go pull another 500, maybe I can recoup my loss here. I mean, that's when you start entering into a territory of, hey, I'm not trading smart. Rather, I'm trading what my mind wants, what I'm goals, or I'm trading money, and that's it. I'm not trading what the market's giving me. When it comes down to this whole idea of capital preservation, I look at it in a couple of different lights. First and foremost, trading has really changed from what it used to be to what it is now. Used to be on the floor. You were a market maker. Your job was to fill orders and then find ways to make money with what you filled on. That was kind of that first step. If you saw a big order coming into the pit, my job was to try and get a percentage of that and then figure out, okay, here's where we're at. This is what we've got. How do we find a way to make money out of what we just did? That's totally changed. The broker's not looking for the guy who's constantly putting his hand up and helping him fill those orders, especially the orders that people weren't really interested in. But if you were filling him, he was going to see you in something good, and then he'd give you a bigger piece of the pie, and then you've got a great chance to make money. That's no longer the case. All you are is a click of a mouse. No one sees the other side and who's filling those orders. So this is a huge advantage we have to being at home. It's that patience, and you can take what you want and you can get involved in it. The hard part is when you're on the screens, there's always something happening, or at least you think something's happening, because you're seeing the dome move up and down, up and down. You're watching your charts ebb and flow. Where in the floor, it wasn't 24/7 constant guys scream. You'd come in and it'd come in waves, and you'd be able to get in and get out. So that's kind of this transition we've taken. And now it's allowed us to focus from being a trader to managing our capital. Here's how much I have. My goal is to grow this. And just because I see something does not mean that's a trade for me to take. If you have that plan going into things and you know your areas that you're looking for an opportunity, and you have your hypothesis of, okay, here's my 3 ways this market can move today: up, down, or sideways. I mean, that's what this market can do. There's not many, can't go backwards. We can't run the other way and redo what we did yesterday. It's always going to be something new. And if you can kind of put together a plan around those 3 ideas and not marry a bias, I think that's happened a lot over the last 10 years for equity traders. They married a bias to the long side, and that's what they're looking for because it's paid them. And if you look back at your trades for the last 10 years, you can say, hey, I made most of my money long. So therefore I'm a long side trader, and that's what I like to see. And then all of a sudden days like yesterday come. Huge opportunity to make money. But how many people struggled yesterday because it was a down day and they're not psychologically thinking about the down day? But if you have a plan around all 3 market states and you say, here's what it can do If I start to see this thing turn down, I'm looking for acceptance to the downside. I'm looking for momentum to continue that way. Here's my plan. Here are areas I'm going to look for. I'm going to remind myself every time I see it approach level. Don't jump in right away. Wait to see a little bit of strength come into that market. Boom, there's my chance to take that short and move it lower. It's always fun and exciting to talk about how much money we can make. But if we're just seeing a downside move, we have to think about where's my risk and where can I control this? And you got to wait for those areas. Just because you got momentum, you want to wait for that area to start to see that market come up, give us some relief, and then boom, we can take that short and move it lower.
And I think when you talk about some of the impatience people have, you know, a lot of people out there in Top Step are trading the NASDAQ, which is a super whippy future right now. So it becomes a little bit, you're right, there's always action. So it feels like you got to be in there or something like that. But this leads into, I'll kind of expand for these last few minutes here and be like, to preserve your capital, you need to also have a good idea of what your risk is. And I was thinking about this in context of, I don't know if you guys have been following some of these things that have been happening in cryptocurrencies lately, some of the collapses of these yield bearing, and I apologize out there if I am not quite saying this exactly right, but it seems like some of these yield bearing things have just collapsed. And I saw online somewhere, there was an example of some influencer was talking about, oh, this is how you buy a $1.4 million house for $700,000. And it was like, you know, X for the down payment. And then you put the rest in this crypto yield thing that gives you 20% a year. And then you pay the mortgage with the interest from that. And you end up paying for it with like $700,000. No way that could go wrong. Right. But I think that there was a lot of people out there who unfortunately did not have a good idea of the risk of what they're doing. And that's of course true in cryptos and stuff like that, but it's true in futures too, is every time people always want to trade more size. I get it. Size sometimes becomes a goal of itself, but I don't think sometimes people appreciate just how much money and how much volatility in your account you're going to have when you're trading 5 full-size futures of something, let alone 10 or 15 or something like that. Mick, you're the risk manager. Maybe you could elaborate on this a little.
As you were saying that, Jack, I remember when I started trading for myself, I met with my old boss who was down in the grain floor, and he was a pretty large trader. And we were talking markets, and this was when there was a bull run up in crude oil. It was just on its way up to the, $145 a barrel years ago. And he was telling me, he's like, you need 200 grand in your account to trade a one lot in this market right now. And, hearing that from someone who, did do size, he was a spreader. So he always had his risk spread, doing the calendar spreads. But that was something that, I obviously still remember, just hearing you, bring something up along those lines. Heck, I mean, margins on these, equity indices are pushing 20 grand. I actually haven't checked since we've, had this big slide to the downside. But, prior to that, you almost need 20 grand in your account just to work an order in the NASDAQ, unless you have some kind of situation with your clearing firm or your brokerage firm. You need a lot to trade. And one thing, you have to remember too, with the size is that we're trading we're trading commodity futures or equity futures. These are futures. They're highly leveraged. It's not like stocks where, if your stock that you own goes to $0, you just lose what you put in. There are, many, many horror stories of traders losing far more than they started out with, or far more than they have in their account. You can go into pretty significant debt nowadays.
Yeah. I'd love to just kind of add one thing to this too, right? Like just because a standard tick value for crude oil is $10, right? Everyone kind of thinks, well, just because about, it's changed or we're trading 130 a barrel or whatever the case may be, it's just a $10 a tick, nothing changed there. Well, ranges change. And all of a sudden we go from where we were a year ago, trading 30, 40, 50 cent ranges to $5, $6, $7, $8, $9, $10 ranges. Capital, the amount of money you have in your account per contract, you have to keep that type of stuff in mind. I look at this stuff right now. If I'm going to trade crude oil, the amount of cash, legit cash, not just based on margins, but the cash I have literally in value in that account. If I'm under $10,000, I'm not very comfortable trading a one lot in crude oil. Like that is an intimidating market when we're seeing these 5, 6, 7, 8, 9, 10% moves from low to high, high to low. And I'm not talking just from settlement price, but we're seeing these huge swings. If I'm seeing a market like that move $8 in a day on a one lot, it's $8,000. Like that's an insane amount of capital to be putting at risk.
Dan, so happy you brought it up. I mean, let's look at one market that's $10 a tick. Nat gas today, in the matter of an hour, sold off 1,600 ticks. If you were long a one lot from the highs before the sell-off, that's a $16,000 loser in less than 60 minutes. I mean, that speaks for itself right there. How about that?
Yeah.
And you could be long and you're just looking to get out of that trade, but who knows? The slippage starts to come in and you're trying to get out, but there's no one on the other side because it's moving so damn quick.
Yep.
When you put on a single ES E-mini, I'm not going to try and do the math in my head because it's not right at 4,000, but it's close enough. So at 4,000, the index, every time you put on an ES, you're shorting or going long 200 grand worth of the S&P 500. That's just something to maybe be in your head. You want to trade 5? Okay, that's a million. 15, $3 million worth it. Like you can't trade $3 million of anything without a lot of, just think about how far that has to move for you to get completely blown out. So don't want to be like Nostradamus here or anything. And I see that also we're in an unusual Zoom setting today. So we got to wrap this up in the next 2 minutes or so. So Ho, you have any parting words of wisdom?
Sure. I'm going to use something Mick mentions quite often as far as risk and reward is concerned. You're going to have losses. You want to keep them small. You want to just do what Mick says. Every time you get into the markets, take 2 steps forward and 1 step back, and don't over leverage. People want to leverage. They want to add to their positions way too quickly. There was a guy in the S&P, Louis, who was a big trader, and he got clipped, and his clearing firm said, all you can do are 5 lots now. The first thing he did was take down a 50 lot and write down 10 5 lots on his cards. It's not what you want to do. So 2 steps forward, 1 step back. You can do this.
Yeah, thanks, Hogue. And Dan, you want to get a quote in at the buzzer?
Yeah, I like this. It comes from an investor, Steve Clark. Do more of what works and less of what doesn't.
God, I just got to do that in life right now.
Yeah, right.
But the stuff that doesn't work is so much fun.
So simple.
Absolutely. Well, thanks everyone out there for tuning in this week. We'll be back next week. We got Make Hogue Money, and we have the forecast every morning, 7:45. Make Hogue Money on Tuesdays and Thursdays at 8:20. Dan and I will be here for the podcast at 3 on Thursday, I believe. But meantime, have a wonderful day. Protect your capital. You'll do great. That's all for now. See you next week.